Howdy, Jacob here. Today I'm going to go into a little more in-depth analysis on Lazard. This is a company I did a little bit ago, and I got to a price that is currently 1% off from getting 15% return. So to me, this is a time where I want to do more research on the company to see whether I think that these assumptions make sense or not, and whether I will want to get in and presume a 15% return is actually accurate given the assumptions. And so, just a quick reminder of the business itself. So, Lazard is a capital markets industry. They operate as a financial advisory and asset management firm. It was actually founded in 1948. So, quite an old company. They got a lot of assets under management. They produce a lot of good amount of income from financial advisory, and we can see that from 2018 to 2022, 2.872 billion to 2.826 billion. We can see that over the long run, it's relatively flat. We see that there's a huge return on invested capital for most years. The low is 8.2, and actually the most recent year, and then as high as 45.7% in 2015. But pretty consistently double digits, low to mid double digits, which is very likely well above their weighted average cost of capital. But a company that doesn't reinvest back in itself, or in asset management, it's kind of difficult because you're working with assets under management, so it's not the reinvestment into yourself is heavily based on individuals also reinvesting into um, your company, and so their payout is pretty big between their common stock and dividends, but their actual dividend payment is about 170 million, and their 5-year average is probably $600 million. So they can definitely afford that. But they also like to use a lot of their excess free cash flow to buy back shares, and so they might not want to increase that too much. But they do have a pretty long history of increasing dividends. Looks like 2021 was the only year they did increase it. Otherwise, most recent years, 1.6%, 0%, 3.2%. So the first thing I'm going to say is that 3% increase that I'm seeing, or that I initially made assumptions for, I'm fine with that just because their payout is really low. And so um, I know people are really interested in buying dividend stocks. And so, although buying back shares at a cheap price makes more sense from a financially, the reallocation of money makes more sense for buying back cheap shares than paying out a dividend if you think that the return is greater than, let's say, 10% that the average person will make in the market, or not the average person, but that the market will make roughly over the long term. If you can get 15% return by buying back shares, that would make more sense. But companies really, or individuals that invest in companies, the average individual really loves seeing dividend increases. So I'm saying that they can't afford that 3%. So let's just say that they do that. As for some of the notes that I took out from reading some of their quarterly results, their CEO said some vague comments in um, some of the most recent reports. And so this one says today's announcement of our conversion to a C corporation positions us to attract a broader base of investors, enhances liquidity, and reflects our focus on delivering long term value to shareholders. It's really just saying, like, we made a change. We made the change to hopefully do XYZ. In the process, it will increase value of shareholders. I mean, that's just the most basic words you could see. And I looked at the last couple quarterly reports, and it was all very vague, nothing that spewed out any specifics. So not necessarily bad, but just want to keep that in mind that there's not a lot of information shed on the actual report itself. Another big thing I wanted to call out is that financial advisory revenue is down 30% year to date. So 9 months of 2023 versus the same 9 months in 2022 is down 30%, and the financial advisory is down 30%, and financial advisory is half of their current revenue. And so we're seeing that's just right there. If it were 30% on 50, that's 15% decline if the other one was flat. And so that's a big hit. That is a humongous hit to their revenue. And then their assets under management was actually also down about 5% year to date. So same 9 months, 2023 versus 2022. And again, asset management, because it's really just financial advisory versus asset management, makes up about half of the current revenue. So pretty big decrease in revenue, 9 months over 9 months. If we look at the average of the 9 months, so this was taking the most recent 9 month period, so 2023 and let's say an October 1st snapshot, really versus a 2022 October 1st snapshot was 5% down. If you take the average of the first 9 months versus 2023, same with the 2022, it's relatively flat. So they're converting to an S corp, like the CEO said. The goal of this is to simplify shareholder tax reporting and hopefully increase liquidity, but this will increase their effective tax rate. And so the goal of converting to an S corp is to um, really hopefully increase liquidity to them and make their shares more open, so more people can invest in them. But their tax rate will go up um, for this change, for this conversion. And so maybe over the long run it works. I don't I don't know these type of things well enough to see if it makes sense or not. So I'm just gonna maybe put a little bit of conservatism in my assumptions due to changes that I am not super familiar with. But to me, um, it sounds like there's really going to be no changes to any of my assumptions due to that. So another thing, 2023 year to date, returned 285 million to shareholders, 129 million in dividends, 102 million in share repurchases, and 45 million in employee tax obligations of share issuances. So you can see it's almost 50-50 on dividend versus share repurchases, with just a little extra on their employee tax obligations of share issuance. So like I said, revenue down almost 30% year over year, largely due to investment banking and other advisory fees down very heavy. Their total operating expenses are down only 7%, resulting in a net income drop of 90%. So huge net income drop. Looks like they're still producing net income, but it's way less than before. Their free cash flow yield is roughly minus 200 million. And then negative cash flow is the reason for the company's cash value on the balance sheet, going from roughly 2.6 a year ago to a flat $1 million in the most recent quarter. And so if they what that line is saying is that if they can't go back to making the type of money that they have, it could be a problem for their dividend and for their share repurchases. But they do have a good amount of cash on hand to help with that. $1 million versus their payout of 172 million. They're still in a pretty safe region, but they do have long-term debt of 1.7 billion. So definitely something to keep in mind when investing into this company. I think if you're confident that they can go back to making the free cash flow or the cash flow margin and earnings margins that they have in the past, and it may still make sense to you, then I'd keep investing in it. But let me show you my new assumptions. So initially I had 2%. I'm going negative 2%, just because a drop of 30% is really going to hinder their ability now, and then maybe they'll increase it down the road. But for now, I'm just assuming pretty bad scenario happens. And then 12% on the free cash flow, 20% on free cash flow margin, or the net income and free cash flow margin dropped a little bit. I did 1% share change. I dropped that down because, again, their cash flow is going down in the most recent quarter. I don't want to take too much, I don't want to read too much into it, but just something to keep in mind. And then 7 on the P, price free cash flow based on history, 15% return. And that's telling me that the company's stock price would have to fall 52% to give me a 15% return. I think the last thing I'm going to go over is based on my share repurchases. The last 2 quarters, they've repurchased essentially nothing. So 2.6 million 3 quarters ago, and we're already at 85,000 shares straight up outstanding. So repurchased. So you can see that they're buying back way less shares. And it's just a company that I'm just going to have to wait on right now. So thank you, and hope you have a good rest of your day.